Okay, this is Chapter 11, Central Banks and the Federal Reserve System. This will be the first of two podcasts on this chapter. When our country was first formed, there was a resistance to the establishment of a central bank. Reasons being was citizens were fearful of a centralized power and having basically all this power held in the hands of just a few powerful citizens. So there was a big distrust of the moneyed interests, which were the very successful, wealthy citizens of the time. The problem, though, was that there was no lender of last resort, and what we saw was there were nationwide bank panics that occurred on a regular basis. They were fairly frequent. As a matter of fact, the panic of 1907 was so severe that at this point the public was sick of all of these bank panics and they were convinced that there was a need for a central bank. So the Federal Reserve Act of 1913 established the Federal Reserve System. It was set up so that it would be decentralized and would have an elaborate system of checks and balances. The writers of the Federal Reserve Act wanted to make sure that power was evenly or more uh, widely distributed among not only the government but along the private sector and among bankers and businesses and the public. Furthermore, it broke it down into regions, so it wasn't just one powerful bank, it was made up of 12 regional banks as well. This initial diffusion of power then has resulted in the evolution of the Federal Reserve System. It includes the Federal Reserve Banks. It includes the Board of Governors of the Federal Reserve System. There is an entity that is very useful in terms of conducting or executing monetary policy. That would be the Federal Open Market Committee. There is the Federal Advisory Council. And in addition to all this, there's about 2,900 to 3,000 member commercial banks that are part of the Federal Reserve System. In podcast number 1, we're going to basically focus on the Federal Reserve Banks. We'll discuss the member banks and a little bit about the Federal Advisory Council. In podcast 2, we'll focus heavily on the Board of Governors as well as on the Federal Open Market Committee and the execution of monetary policy through the reserve rates, through open market operations, which is buying and selling securities to affect the money supply, and the setting of the discount rate. Okay, so the Federal Reserve Bank then is a quasi-public institution that's owned by its member commercial banks, the private commercial banks that are in the district of the Federal Reserve. They are allowed to purchase stock in the District Federal Reserve Bank, which can pay dividends up to a limit of 6% per annum. Now, this is under review by Congress, and it is possible in the future that this dividend could be reduced significantly or could be entirely eliminated. The Federal Reserve Banks then are made up of member banks. The member banks will elect 6 directors for each of the district, for each of the 12 districts. 3 more directors will be appointed by the Board of Governors. So out of these 9 directors that are appointed for each Federal Reserve Bank, 3 directors will be professional bankers, 3 other directors will be prominent leaders from industry, labor, agriculture, or the consumer sector, and then the remaining 3 directors are appointed by the Board of Governors, and they're not allowed to be officers, employees, or stockholders of the banks. The directors then are designed to reflect all the constituencies of the public. Again, that broad diversion of power, making sure that it is decentralized and not controlled by just a few people. These 9 directors then will appoint the president of each Federal Reserve Bank, and this will be subject to the approval of the Board of Governors. So going back here, we're talking about the Federal Reserve Banks here being established, and then these directors will appoint the president, which has to be approved by the Board of Governors. Okay, so the 12 Federal Reserve districts, I'm not going to make you memorize which ones they are, but they are set up in the following different regions. Now, the Federal Reserve of New York is probably the most powerful of all the Federal Reserve banks. It actually controls about 25% of all the assets of the Federal Reserve System. if we were to combine Chicago, San Francisco, and New York, they would control approximately 50% of all the assets. So again, New York is the most powerful Federal Reserve Bank in terms of the assets that it has. And then if we were to include Chicago and San Francisco, that would make up 50% of the assets. So 3 banks out of the 12 control 50% of the assets in the Federal Reserve System. Some of the functions of the Federal Reserve Bank: 1, they will go ahead and clear checks for the member banks. They will go ahead and issue new currency. They will also withdraw any damaged currency from circulation. They are responsible for administering and making discount loans to banks in their districts. And they also evaluate proposed mergers and applications for banks to go ahead and expand their activities. They act as liaisons between the business community and the Federal Reserve System. They will also go ahead and conduct bank audits, or they will examine bank holding companies and state chartered banks. They collect data on local business conditions, and they also have a staff of professional economists that will research topics that relate to monetary policy. So the Federal Reserve banks perform quite a few different functions. The Federal Reserve banks then are also responsible for assisting in the monetary policy of the Federal Reserve. They will help to establish, or they will help to concur on what the discount rate should be. They will also decide which banks in their district can obtain discount loans. Those are loans through the discount window. Directors will select a commercial banker from each of their district to serve on the Federal Advisory Council. This Federal Advisory Council then will consult with the Board of Governors and provide information to help conduct monetary policy. So the Federal Advisory Council, then, just going back to the schematic, fits in right here. And they provide consulting services basically to the Board of Governors. Five of the 12 bank presidents, then, out of the 12 different Federal Reserve banks that we have, 5 of those 12 bank presidents will have a vote with the chairman on the Federal Open Market Committee. That, again, will be responsible for setting what the monetary policy will be. Member banks, then, belong to their Federal Reserve Bank. They are national banks that are required to be members of the Federal Reserve System. Commercial banks that are chartered by banks, so these tend to be smaller banks, are not required but can choose to be members. And it's actually more advantageous to them to be members of the Federal Reserve Bank because it will allow them to have access to the discount window. The Depository Institutions Deregulation and Monetary Control Act, otherwise known as DIDMCA Act, subjected all the banks, whether they were chartered by the state or federal members, they subjected them to the same reserve requirements as all member banks. So in effect, this gave all banks, whether they were federal banks or state chartered banks, access to Federal Reserve facilities. So this sort of evened the playing field. Basically, the state banks didn't want to be a member in the beginning because the reserves that they had to hold didn't receive any interest. And as interest rates went up, that became more and more valuable to them. But now, pretty much through this regulation of 1980, all state and federal banks belong to the Federal Reserve System. Okay, why don't we go ahead and end the first podcast here. We'll come back and we'll discuss the Board of Governors of the Federal Reserve System and the Federal Open Market Committee.